The markets are a mirror. They reflect not what we want to see, but who we are inside. Every tick, every wave of price movement, every surge and collapse in momentum. It all tells a story of human behavior repeating itself through time. The irony is that while everyone searches for the next big trend, few ever learn how to truly catch one. Most traders chase what they wish the market would do, not what it's actually doing. They're seduced by the illusion of certainty, believing they can outguess something that thrives on uncertainty. Catching a big trend isn't about predicting the future. It's about aligning yourself with the flow of the present. The market doesn't hide its intentions. It reveals them in structure, rhythm, and energy. But to see it, you have to quiet the internal noise of fear, greed, hesitation, and the constant need to be right. These emotions create resistance, and resistance blinds you. The difference between the trader who rides a massive move and the one who gets shaken out before it begins lies not in strategy, but in perception. Big trends start small. They begin in the quiet, unremarkable corners of the chart where most eyes aren't looking. By the time the majority recognizes the movement, the opportunity has already shifted. The early part of every major trend feels uncomfortable, even wrong. That discomfort is the test, the filter separating those who trust the process from those who need reassurance. You cannot catch a big trend while needing proof it exists. Proof only appears once the move is nearly over. To catch the big ones, you must redefine your relationship with risk. The market doesn't reward control, it rewards surrender. Control is an illusion, a fragile structure built from the need to avoid pain. But surrender doesn't mean recklessness. It means flowing with what is instead of fighting for what should be. It means allowing uncertainty to exist without needing to eliminate it. Once you accept that uncertainty is the foundation of trading, you stop reacting emotionally and start observing neutrally. Every big trend leaves footprints: accumulation, expansion, pullback, continuation. The technical patterns repeat endlessly, but the trader's internal state determines whether they can recognize them in real time. The same setup that one trader sees as an opportunity, another sees as a trap. The chart hasn't changed, only the observer has. Catching big trends, then, is not a mechanical act, it's psychological alignment. It's the art of sensing your beliefs with the market's reality. When your internal environment mirrors the neutrality of price action, you become fluid. You stop forcing trades, you stop missing moves because of hesitation. You begin to sense the rhythm, that subtle shift when randomness gives way to direction. That's when you're no longer hunting the trend, you're part of it. To align with the market's flow, not your expectations, is to understand that the market exists independently of your desires, opinions, or predictions. It doesn't respond to what you think it should do, nor does it reward your conviction. The market moves according to its own rhythm, driven by collective perception, emotion, and action. Most traders enter the market carrying an invisible burden, the need to be right. They project their expectations onto price action, assuming that the market must comply with their analysis, their logic, their belief in what makes sense. But the market doesn't care about logic. It's an ecosystem of probabilities, constantly shifting between order and chaos, structure and randomness. To align with its flow, you must release the illusion that your view has any influence on what will happen next. Expectations are subtle traps. They begin as confidence but quickly evolve into attachment. Once you expect a certain outcome, you become emotionally tied to. When the market moves against that expectation, frustration rises and clarity disappears. You start interpreting every tick as either confirmation or threat, filtering information through the lens of what you want to see rather than what A is. This is where most traders lose alignment. They stop observing and start arguing. The inner dialogue turns into a battle of justification. It has to turn here. It's just a pullback. The fundamentals support my view. In truth, none of that matters. The market isn't listening. It's simply doing what it does, moving through cycles of imbalance and equilibrium. Alignment begins when you stop demanding that the market validate your expectations. It starts when you realize that your analysis doesn't need to be right, it needs to be adaptive. The goal isn't to predict, but to participate. When you let go of needing the market to move your way, you open yourself to perceiving what's actually unfolding. The flow of the market is like a river, sometimes fast and directional, other times slow and choppy. If you try to impose your path on it, you struggle. But if you move with it, you conserve energy and gain clarity. True alignment is a state of awareness, not a strategy. It's the ability to see the market without distortion, to observe price movement objectively without adding your emotional bias to it. Every trader talks about following the trend, but few understand that following requires surrender. You can't follow something you're trying to control. The more you try to force trades based on what you think should happen, the more you separate yourself from the market's natural rhythm. This disconnection creates friction. You start entering too early, exiting too late, chasing moves you've missed, and doubting the setups that fit perfectly. All of this is a symptom of misalignment, of being trapped in expectation instead of flow. The flow of the market is not random, but it's not predictable in the way most want it to be. It's patterned yet fluid. When you align with it, you begin to sense its transitions, moments when momentum builds, when energy pauses, when volatility compresses before expansion. You can't read this from a textbook. It's something you feel through observation and patience. Alignment is born from immersion, from spending enough time with price action to internalize its rhythm. The more you study the market without needing something from it, the clearer it becomes. Expectations create tension. They pull you out of the present and anchor you to a possible future that may never occur. Flow, on the other hand, exists only in the now. When you're aligned, you respond to what the market is doing rather than what you hope it will do. That shift in mindset transforms everything. It turns hesitation into decisiveness because your actions are based on what's visible, not imagined. It removes the emotional swing between euphoria and despair because you stop measuring success by the accuracy of your predictions. Instead, success becomes synonymous with discipline and presence. The process of alignment requires humility. You must accept that the market will always be bigger, faster, and smarter than you. It's a system driven by countless variables, institutional algorithms, macro events, psychology, liquidity, and timing, all interacting beyond your control. Trying to outthink this system is futile. But understanding how to synchronize you with it is power. You don't need to know why the market is moving, you only need to recognize that it is and respond accordingly. This acceptance liberates you from the need for certainty. When you release expectations, you become fluid. You start to flow with the direction of energy rather than fight it. The market shifts from being an adversary to a mirror. Every moment reflects your internal state: impatience, greed, fear, discipline, or neutrality. Alignment is not about mastering the market, it's about mastering yourself. The more you bring emotional balance to your trading, the more accurately you perceive external movement. Price patterns reveal themselves not through force but through stillness of perception. Most traders believe they're analyzing the market, but in reality they're analyzing their expectations. They project narratives. This level will hold, this breakout will continue, this divergence must resolve upward. These statements are built on hope disguised as logic. The aligned trader doesn't hope, they observe. They wait for the market to confirm through action, not opinion. They act when flow is visible, when behavior aligns with structure, when momentum validates intention. To align with the flow also means to detach from the need for perfection. You'll never catch every move, never buy the exact bottom, never sell the exact top. Those are illusions born from hindsight. The flow doesn't demand precision, it demands participation. When you stop chasing perfection, you start seeing probability. You accept that losing trades are not failures but natural expressions of randomness within the flow. This perspective allows consistency to emerge because your behavior becomes stable even when the market isn't. Alignment transforms your time perspective as well. Expectations are future-oriented. They tie your emotions to outcomes that don't yet exist. The flow is present-oriented. It keeps your awareness grounded in the current moment where all decision-making power resides. When you operate from flow, you're no longer reacting to missed opportunities or anticipated results. You're simply responding to what is unfolding right now. That response, unburdened by emotional distortion, becomes your edge. The flow of the market is continuous. It never stops, never sleeps. It expands and contracts in waves, moving through accumulation, breakout, retracement, continuation, exhaustion. To align with it, you must learn to sense its tempo, when it's breathing in and when it's breathing out. That awareness can't be forced. It develops through repetition and mindfulness. Every chart, every time frame, every trade becomes an opportunity to study flow rather than impose prediction. The more you align, the less you need the market to reward you. Your focus shifts from outcome to process, from expectation to observation. You begin to recognize that the market's flow is simply an expression of mass psychology, collective fear and greed oscillating in patterns. You learn to flow not just with price, but with sentiment, volatility, and tempo. You become an interpreter of rhythm rather than a predictor of direction. And as that alignment deepens, you find that clarity replaces confusion. Patience replaces urgency. Observation replaces reaction. The market no longer feels like chaos. It feels alive, and you're finally moving with it instead of against it. To accept uncertainty as the core of trading is to confront one of the most uncomfortable truths about the market and about yourself. Every trade, every decision, every tick of price movement exists within a field of unknown outcomes. You can study the charts, analyze the data, calculate probabilities, and develop the most refined system in existence, but none of it can eliminate uncertainty. The moment you enter a position, you step into a world where control doesn't exist. Most traders resist this truth. They crave certainty because the human mind is wired to seek safety and predictability. But the market is not a safe or predictable environment. It's a dynamic expression of collective perception and emotion. To survive and thrive within it, you must learn not just to tolerate uncertainty, but to embrace it as the foundation of every opportunity. Uncertainty is what makes the market move. Without it, there would be no risk and therefore no reward. Every buyer and seller acts based on their interpretation of incomplete information, creating the constant imbalance that drives price action. Traders who fear uncertainty are essentially fearing the very mechanism that generates profit potential. They build rigid systems, overanalyze data, and seek confirmation after confirmation, all in an attempt to escape discomfort. But this behavior doesn't reduce uncertainty, it amplifies frustration. The tighter you try to grip the market, the more it slips through your fingers. The paradox is that the only way to gain stability in trading is to stop demanding it from the market and start creating it internally. Acceptance of uncertainty begins with a shift in mindset. Most traders view uncertainty as danger, as something to be conquered or eliminated. The aligned trader views it as information. When you accept that the outcome of any single trade is unknowable, you free yourself from the emotional burden of being right. You no longer measure success by the result of one trade, but by your ability to execute consistently over many. This detachment allows clarity to emerge. You stop needing the market to reward you and start focusing on how well you follow your process. The randomness of short-term outcomes no longer shakes your confidence because you understand that probability, not prediction, governs success. The illusion of certainty seduces traders with promises of control. They look for patterns that never fail, indicators that never lie, systems that guarantee wins. But the market has no obligation to repeat itself in the same way twice. Historical data can guide, but it cannot assure. Every moment is unique because every moment is shaped by new information and emotion entering the system. What worked yesterday may not work today, not because the market is broken, but because it's alive. Once you accept that uncertainty is not an obstacle but the essence of the game, your relationship with trading changes completely. You stop trying to eliminate the unknown and start learning how to operate within it with confidence and composure. Fear of uncertainty often disguises itself as the need for more information. Traders convince themselves that if they just analyze a little more, wait for one more confirmation, or tweak one more parameter, they'll finally find certainty. But more information rarely brings clarity, it often creates paralysis. The markets don't reward those who know the most, they reward those who can act decisively under uncertain conditions. conditions. Action is what converts potential into profit. The ability to act without complete knowledge is the defining trait of a professional trader. It's not recklessness, it's the recognition that perfection doesn't exist and hesitation has a cost. Accepting uncertainty also means redefining your relationship with loss. Most traders see losses as proof of failure, as evidence that something went wrong. In reality, losses are just part of the statistical distribution of outcomes. Every strategy has a random sequence of wins and losses. The aligned trader doesn't attach emotion to this sequence. They understand that uncertainty ensures variability. You cannot know which trade will win or lose, but you can know that if your edge is real and your risk is controlled, the results will balance over time. By accepting uncertainty, you stop trying to predict which trade will be the winner and focus instead on executing your edge repeatedly with discipline. This acceptance doesn't mean indifference. It means emotional neutrality. When uncertainty no longer triggers fear, you start to see the market objectively. You can observe fluctuations without personalizing them. The mind becomes calm, and calmness leads to precision. Most trading mistakes, hesitation, overtrading, revenge trading, cutting winners short, come from an inability to accept uncertainty. The mind tries to escape the discomfort of not knowing by forcing premature action. But when you embrace uncertainty, you no longer need to force anything. You wait for the market to show its hand, and when it does, you act without hesitation or doubt. There's a deep paradox in trading psychology. The more you try to avoid uncertainty, the more uncertain you feel. This is because avoidance reinforces fear. When you accept it fully, fear dissolves. You no longer need the market to behave a certain way for you to feel at ease. Your sense of security comes from within, from your ability to manage risk, to follow your plan, and to remain detached from outcome. This inner stability becomes your anchor in the ever-changing sea of price movement. Uncertainty is not chaos, it's potential. Every tick in the market represents countless possibilities unfolding. Some of those possibilities will align with your position, others won't. Your job is not to know which one will occur, but to position yourself in such a way that when probability favors you, you're ready to capture it, and when it doesn't, you're protected. This is how professionals think. They don't try to eliminate uncertainty, they structure their approach to thrive within it. Risk management, position sizing, and consistent execution are all tools for converting uncertainty into controlled exposure. When you accept uncertainty, you also learn to listen to the market rather than impose your will on it. You become responsive instead of reactive. The market speaks through price, through rhythm, through imbalance, but you can't hear it when you're consumed by the need to know. The noise of your own expectations drowns out the subtle cues of flow. Acceptance clears that noise. It allows observation without bias, participation without attachment. You stop treating uncertainty as an enemy and begin to see it as the very condition that keeps the game alive. The irony of mastery in trading is that the deeper your acceptance of uncertainty, the more predictable the market becomes, not in the sense that you can forecast every move, but in the sense that your behavior becomes predictable. You no longer act impulsively. You no longer chase or panic. You respond the same way to the same conditions regardless of temporary outcomes. That consistency turns uncertainty into an ally because it allows probability to express itself over time. At its core, trading is a psychological exercise in managing discomfort. The charts are merely reflections of collective uncertainty playing out in real time. Your ability to remain calm in that environment determines everything. Accepting uncertainty doesn't remove risk, but it removes the emotional turbulence that makes risk unbearable. You learn to coexist with the unknown, to operate within it, to find freedom in it. The moment you stop resisting uncertainty is the moment you stop needing control. And when you stop needing control, you begin to move in sync with the market's rhythm, adapting effortlessly as it changes, flowing naturally with what it offers in each moment, recognizing big trends in their early, uncomfortable stages requires a level of awareness that most traders never develop, because it demands going against human nature. The beginning of every major move looks uncertain, messy, even illogical. The market doesn't announce its intentions with clarity, it whispers them through subtle shifts in behavior, structure, and momentum. To the untrained eye, these moments look like noise or indecision. To the trader attuned to flow and psychology, they signal transition. The uncomfortable truth is that the best opportunities rarely feel comfortable when they first appear. Comfort comes later, once the move is obvious, once the crowd begins to notice, and once most of the profit potential is already gone. The psychology of the crowd operates on reassurance. Traders and investors feel safest when they see confirmation from price action and sentiment, when everyone begins to agree that a trend exists. But by the time consensus forms, the early entry points have vanished. The market rewards those who act before confirmation and punishes those who need it. To recognize big trends early, you must learn to interpret discomfort as a signal rather than a warning. Discomfort often means you're seeing something the crowd hasn't accepted yet. That tension between what is beginning to happen and what most still deny is where major moves are born. Early trend recognition begins with detachment from the need for certainty. You can't wait for the market to make you feel right before you act. The structure of a new trend always begins in uncertainty. Volatility compresses, volume, behavior changes, failed patterns start to flip direction. The technical clues are there, but they don't look clean or textbook perfect. They require interpretation through context, not through rigid rules. The trader who waits for a flawless setup misses the living moment where opportunity first takes shape. Big trends are organic. They don't conform neatly to theoretical definitions. They evolve, and your job is to recognize that evolution as it unfolds. The early phase of a big trend often feels wrong because it defies recent memory. The market may have been trending in the opposite direction for weeks or months. When price begins to reverse, it challenges every bias built from that past movement. Most traders anchor to what has been happening and assume it will continue. This anchoring blinds them to the new momentum emerging beneath the surface. They interpret every early breakout as a fake move. Every reversal is a temporary correction. By the time time the shift becomes undeniable, the market has already moved too far for a low-risk entry. To recognize trends early, you must learn to release attachment to the past and see each moment as independent from the one before it. The discomfort in early trend stages isn't just intellectual, it's deeply emotional. Entering when the chart still looks uncertain triggers fear. You fear being wrong, being early, looking foolish, losing money. These emotions create hesitation, and hesitation is the graveyard of opportunity. The market tests conviction not by hiding information, but by making truth feel uncomfortable. The emotional resistance you feel during the early stage of a potential trend is the same resistance most others feel. This collective hesitation is what keeps the trade asymmetric, high potential reward with limited participation. The trader who can act amid uncertainty, guided by process rather than emotion, becomes positioned before the crowd. Recognizing these early signs also requires a shift from reactive observation to anticipatory awareness. You must learn to sense energy shifts in the market before they become obvious. This doesn't mean guessing or gambling, it means paying attention to behavior. When momentum slows after a long run, when volatility contracts unusually, when failed breakouts start to reverse with strength, these are not coincidences. They're expressions of shifting sentiment. Market participants are adjusting their beliefs, and that adjustment creates the foundation for new direction. Big trends don't emerge from nowhere. They form as collective psychology transitions from disbelief to acceptance. The trader's task is to observe that transition while most are still anchored to the old narrative. Pattern recognition alone isn't enough. You can memorize chart formations, but without psychological understanding, you'll still miss the turning points. The early phase of a trend is often marked by contradiction. Good news doesn't move price higher. Bad news stops pushing it lower. These inconsistencies reveal that control is shifting between buyers and sellers. The crowd interprets these moments as confusion, but to the aligned trader, they are early signals of imbalance. The market moves when one side's conviction overwhelms the others, and the earliest evidence of that shift is often subtle. It might appear as higher lows forming beneath resistance, as volume expansion on countertrend moves, or a sudden resilience after what should have been a breakdown. Recognizing these signs requires observation without emotional interference. The hardest part of catching a big trend early isn't identifying the possibility, it's holding through the noise that follows. Early entries always face volatility, retests, and temporary invalidation. This volatility shakes out those who lack belief in their method. The crowd that hesitated to enter early finds comfort only after seeing a series of strong candles, but by then the smart money is already scaling out. To remain positioned during the messy birth of a trend, you must trust your process more than your emotions. Every wiggle and pullback in the early stage is designed to test patience and conviction. The market must remove the weak hands before it can sustain acceleration. Recognizing big trends early also means developing sensitivity to asymmetry. You're not looking for certainty, you're looking for situations where potential reward vastly exceeds risk. These are moments when price structure, momentum, and sentiment align just enough to justify participation. Even though the market hasn't yet confirmed the move, you might be wrong, but the cost of being wrong is small compared to the gain of being right. This understanding transforms how you perceive early stage discomfort. It stops being something to avoid and becomes something to seek. The discomfort tells you that you're entering a zone of opportunity few are willing to explore. The technical layer of early trend recognition supports the psychological layer. Compression patterns, base formations, and breakouts from equilibrium zones often precede expansion phases. But what defines a trader's success isn't their ability to spot these patterns. It's their willingness to act on them before the market validates them publicly. Early trend detection is not about seeing what everyone else can't. It's about having the emotional readiness to act when everyone else won't. The irony is that once a big trend becomes obvious, it becomes dangerous. The entry points are gone, risk is magnified, and the emotional comfort of certainty leads to complacency. Late traders join the move driven by excitement rather than structure, and they eventually become the liquidity for those who entered early. This dynamic repeats across every time frame, from intraday swings to multi-year cycles. The ones who consistently recognize big trends early are those who have trained themselves to think and feel opposite the crowd, not through defiance, but through understanding that discomfort is a feature of opportunity, not a flaw in it. In practical terms, recognizing big trends early means observing where structure and sentiment diverge. When price begins to build strength while headlines still focus on weakness, or when a market refuses to fall despite negative data, you're seeing the early signs of transition. The crowd is still anchored in old beliefs while the market quietly shifts into new territory. These moments of divergence carry immense potential because they represent the intersection of disbelief and change. Every great trend begins in an environment of contradiction. The majority still clings to what has been true, while a small minority begins positioning for what's becoming true. The difference between them lies not in knowledge, but in perception. The early recognizer accepts uncertainty, interprets discomfort, and reads behavior rather than emotion. While others wait for comfort, they align with reality as it begins to unfold. That alignment, uncomfortable, lonely, and often doubted, is what makes the difference between chasing a trend and catching it at its birth. Mastering emotional neutrality to see clearly is one of the most difficult disciplines in trading because it goes against everything that defines normal human behavior. The markets are not just a place where money changes hands, they are a mirror that reflects the trader's inner world. Every decision, hesitation, or impulse on the chart is a reflection of emotion. Fear, greed, excitement, frustration, hope, and regret. Most traders believe they are analyzing price, but in reality, they are reacting to how price makes them feel. Emotional neutrality means stripping away that emotional filter so that what you see on the chart is what is actually there, not what your mind wants to believe is there. To reach that state, you must learn to detach from outcome, to remain calm in the face of uncertainty, and to interpret market behavior with objectivity rather than attachment. The human mind naturally resists neutrality because it's wired for survival, not observation. When price moves against a position, fear activates. When it moves in favor, euphoria takes over. Both reactions distort perception. In fear, the trader trader sees danger everywhere and cuts trades too soon in euphoria. The trader sees endless opportunity and holds too long or over-leverages. The pendulum swings between these emotional extremes create chaos in decision-making. Emotional neutrality is the point where that pendulum stops swinging, where observation becomes pure and decisions arise from logic rather than impulse. Achieving that balance doesn't mean suppressing emotions, it means no longer being ruled by them. The foundation of neutrality begins with acceptance. You must accept that the market owes you nothing, that every trade is independent, and that loss is not failure but part of the process. As long as your identity is tied to the outcome of a trade, neutrality will remain out of reach. Each win will inflate ego and each loss will wound it. This emotional roller coaster clouds perception and keeps you from seeing the market as it truly is. Detachment from outcome doesn't mean indifference. It means understanding that your self-worth and the market's behavior exist on separate planes. When you stop taking market results personally, clarity begins to emerge. Emotional neutrality is not about eliminating passion or caring less about success. It's about shifting your emotional investment from outcome to process. Instead of feeling satisfaction only when a trade wins, you find it in executing your plan flawlessly regardless of result. This reorientation builds resilience because it anchors your confidence in what you can control, your preparation, discipline, and response, rather than what you can't, the market's next move. When your confidence is rooted in process, external fluctuations lose their power over you. A losing trade no longer destabilizes your emotions because you know it doesn't define your ability. A winning trade no longer inflates your ego because you understand it's part of a probability sequence. To see clearly, you must observe without judgment. Most traders analyze charts through a lens of bias. They interpret data in a way that confirms their existing beliefs. If they're long, they search for reasons the market should rise. If they're short, they look for reasons it should fall. This confirmation bias narrows perception and blinds you to critical information. Emotional neutrality dissolves bias because it removes the need for the market to behave a certain way. When you don't need to be right, you're free to see the truth of the market's behavior. You stop fighting reality and start flowing with it. Developing neutrality requires deep self-awareness. You must learn to recognize your emotional triggers. Those moments when your breathing changes, your focus narrows, your heart rate increases, or your thoughts speed up. These are signs that emotion is taking control. Awareness creates the space to pause before reaction. The moment you can observe your own emotion without acting on it, you begin to take back control. It's in that pause that clarity resides. Most impulsive trades come from the inability to pause. The trader feels an emotion and immediately reacts, mistaking reaction for intuition. But intuition in trading isn't emotional. It's a product of experience filtered through neutrality. The practice of neutrality also involves embracing boredom. The market spends most of its time consolidating, not trending. Emotionally driven traders seek excitement. They want constant movement, constant validation. This leads to overtrading and forcing setups that don't exist. The neutral trader, however, is comfortable waiting. Patience is a symptom of emotional control. The ability to do nothing when there's nothing to do is a mark of mastery. Neutrality allows you to detach from the need for action and to recognize that doing nothing is often the most profitable decision. One of the greatest obstacles to neutrality is attachment to money. Money represents more than value. It represents security, freedom, identity, and validation. This emotional weight makes every trade feel personal. When a trade is winning, it feels like confirmation of worth. When it's losing, it feels like rejection. The neutral trader sees money as energy moving in and out, not as a measure of self. They understand that risk is the cost of participation, not something to be avoided or feared. By redefining their relationship with money, they free themselves from emotional swings and begin to perceive opportunities objectively. Clarity in trading comes from stillness, not intensity. Emotional energy clouds perception because it compresses focus around short-term results. The more emotionally charged you are, the narrower your perspective becomes. You start reacting to individual candles instead of understanding the broader structure. You chase impulses rather than recognizing context. Neutrality expands awareness. It allows you to zoom out, to see multiple layers of market behavior at once without becoming overwhelmed. You begin to understand rhythm rather than react to motion. The process of mastering neutrality often feels paradoxical. To gain control, you must stop trying to control. To find clarity, you must stop forcing understanding. Neutrality is a letting go, not a pushing through. It's the ability to let the market do what it will without letting it disturb your inner balance. This doesn't come from indifference, but from trust. Trust in your method, in your discipline, in your ability to adapt. When you trust yourself, you no longer need the market to behave a certain way to feel secure. That trust becomes your anchor in volatility. Neutrality also reshapes time perception. Emotional traders live in micro time. They obsess over every tick, every candle, every fluctuation. Their emotions amplify short-term noise until it feels like truth. Neutral traders live in macro time. They see movement as part of a larger unfolding process. They understand that one trade is meaningless in isolation and that patterns reveal themselves over sequences, not moments. This perspective creates calmness. You stop reacting to each movement as if it defines everything. You start allowing the process to evolve naturally without interference from emotional impatience. Fear and greed are not enemies to be destroyed, they're energies to be understood. When you're neutral, you can sense these emotions without identifying with them. You can feel fear rising but still execute your plan. You can feel greed pulling but still manage risk. This separation between feeling and reaction is what defines mastery. You can't stop emotions from appearing, but you can stop them from deciding for you. The mind becomes like a clear mirror. It reflects what's happening without distortion. Most traders equate success with control over the market, but true success comes from control over self. The market cannot be controlled. It can only be observed and participated in. Emotional neutrality transforms trading from a battle into a dialogue. You stop fighting price and start communicating with it. The chart becomes less about what you want and more about what it's revealing. This dialogue deepens your intuition because intuition thrives in silence, not noise. Neutrality also protects longevity. Emotional highs and lows burn energy, drain focus, and lead to psychological fatigue. Traders who trade from emotion experience cycles of overconfidence followed by despair, which erode consistency. Neutrality creates equilibrium. Each day begins and ends the same way, focused, calm, detached. You no longer ride the emotional roller coaster of wins and losses. This stability compounds over time into greater clarity, efficiency, and confidence. Mastering emotional neutrality is not achieved through knowledge alone. It's cultivated through experience, reflection, and discipline. You must repeatedly face the situations that trigger emotion and learn to remain centered within them. Each time you act with discipline instead of impulse, you strengthen your neutrality. Each time you observe without reacting, you deepen your clarity. Over time, the market's chaos begins to feel calm, not because it changed, but because you did. When your inner world becomes quiet, the external world becomes transparent. That is when you truly begin to see surrendering control and flowing with what is rather than what should be marks the turning point between struggling with the market and moving in harmony with it. The desire for control runs deep in every trader because control feels like safety. It offers the illusion of certainty, of being able to dictate outcomes through knowledge, preparation, or sheer will. But the market is not a system that bends to human desire. It is a living reflection of collective uncertainty, constantly shifting and rebalancing. The harder you try to impose control, the more resistance you create. That resistance becomes tension, and tension clouds perception. True mastery begins when you stop fighting the market's rhythm and start accepting it as it is, moment by moment, without judgment or demand. The need for control is rooted in fear, the fear of loss, of being wrong, of the unknown. The mind craves linear logic. If I do this, then that will happen. But the market doesn't operate on linear equations. It operates on probabilities. Every setup, every signal, every piece of information is part of a distribution of possible outcomes. You can never know which outcome will occur next, only that over time, certain behaviors have statistical edges. The trader who surrenders control understands this and stops trying to force specific results. Instead, they align with the probabilistic nature of the market, allowing randomness to play its role without emotional interference. Surrender doesn't mean giving up, it means giving into reality. It's not passive resignation, it's active acceptance. When you surrender control, you stop resisting what's happening and start responding intelligently to it. Resistance is what causes emotional pain in trading. You lose a trade and immediately feel the urge to make it back, to restore control. The mind cannot tolerate uncertainty, so it tries to reassert dominance through action, usually impulsive and self-destructive. But when you flow with what is, loss becomes feedback, not failure. You adjust, adapt, and move forward without internal chaos. The act of flowing with what is requires awareness. You must observe your own reactions to market movement and see how often they're driven by the need to control. When price moves in your favor, you want to control how long it lasts. When it moves against you, you want to control when it stops. Every desire for control is a subtle denial of reality. The market doesn't care about your entry, your stop, or your target. It moves according to its own dynamics. The more you can release the urge to dictate those dynamics, the clearer you become in perceiving them. Control narrows perception, surrender expands it. Flowing with what is means responding to the market's behavior instead of predicting it. Most traders spend their energy forecasting outcomes rather than aligning with what's unfolding. They create rigid expectations, and when the market defies them, frustration takes over. Flow is the opposite of rigidity. It's the capacity to remain flexible without losing structure, to adapt without losing discipline. You let the market lead and you move in rhythm with its pace. This is not submission but synchronization. When you are in flow, decisions become effortless because they arise naturally from observation, not from the pressure to be right. The paradox of control in trading is that the more you try to control outcomes, the less control you actually have. You tighten stops too early, exit too soon, or hold too long, all in the name of managing the uncontrollable. The trader who learns to surrender discovers that true control lies in controlling oneself, not the market. You can't control where price will go, but you can control your reaction to it. You can't dictate when opportunity will appear, but you can remain ready when it does. This internal control is the foundation of flow. Once you stop battling the external, you redirect energy inward, where real power resides. Flowing with what is also demands humility. It requires admitting that you don't know what will happen next and that you don't need to. The ego resists this because it thrives on the illusion of certainty. It wants to be the hero of every trade, the one who calls the top or bottom, who predicts perfectly. But trading is not about prediction, it's about alignment. The market humbles everyone eventually, and those who refuse to surrender keep repeating the same painful lessons. Humility is freedom because it removes the pressure to be right. You trade what you see, not what you want to see. Surrender transforms time perception. When you try to control the market, you live in the future, constantly projecting what should happen next. This projection pulls you out of the present where real information exists. Flow happens only in the present. It's a state of awareness where you respond to each moment as it unfolds without clinging to the last one or anticipating the next. The present moment is the only point where observation and execution intersect. When you surrender control, you begin to live there fully engaged but emotionally detached. Control often masquerades as discipline, but they are not the same. Discipline is structure, control is fear. Discipline creates boundaries that protect you from chaos. Control tries to manipulate chaos into order. The disciplined trader sets rules and follows them but remains flexible enough to adapt. The controlling trader demands the market conform to their expectations and becomes angry when it doesn't. The disciplined trader flows with structure. The controlling trader fights against change. The difference between them is acceptance. Flowing with what is also changes how you experience losses and wins. When you're attached to control, Each loss feels like a personal attack and each win feels like validation. This creates emotional volatility that mirrors the market's own swings. But when you surrender control, every trade becomes just another expression of probability. Wins and losses lose their emotional charge. You begin to see them as neutral data points, pieces of feedback in a continuous process of refinement. Emotional balance emerges naturally because your identity no longer depends on outcomes. The process of surrender can feel uncomfortable at first because it requires trust in the process and probability and in yourself. The analytical mind resists trust because it wants proof. But proof only exists in hindsight, and hindsight has no power in the present. Trust is what allows you to act decisively in uncertainty. When you flow with what is, you act not because you know, but because you accept not knowing. This acceptance removes hesitation. You enter when your system signals, you exit when it tells you to, and you let the rest unfold. There is no struggle, no second guessing, only rhythm. Surrendering control also means detaching from the illusion of mastery over the market. Mastery doesn't come from dominating the market, but from coexisting with it. The market is a living system that reflects the collective psychology of millions. To think you can control it is to misunderstand its nature. The best traders are not controllers, they are interpreters. They read flow, not dictate it. They know when to step in and when to step aside. This ability comes from deep listening, not from force. You listen to volatility, to tempo, to energy shifts, and you respond accordingly. When you surrender, your trading becomes lighter. You no longer carry the weight of constant anxiety about what should be happening. You stop overanalyzing and start observing. You stop pushing and start allowing. Flow becomes effortless because you're no longer swimming against the current of reality. The irony is that when you surrender control, results often improve because decisions are cleaner, faster, and freer from emotional distortion. You stop trying to make the market behave and instead behave correctly within the market. Flowing with what is doesn't mean you abandon structure or stop managing risk. It means you stop using structure as a weapon against uncertainty. You still define your risk, set your levels, and manage your trades, but you do it from a place of acceptance rather than fear. You know that no setup is guaranteed, and you're okay with that. Your stop is not a threat, it's protection. Your rules are not constraints, they're expressions of trust in your process. When you truly surrender control, you realize that the market doesn't need your opinion to move. It doesn't care about your expectations, your predictions, or your desires. It just moves, and your task is to move with it. You begin to sense flow not as something external, but as a rhythm that includes you. The distinction between you and the market fades. You become part of the same movement. The responding effortlessly to what's unfolding, control disappears, resistance fades, and trading transforms into expression. It becomes a practice of awareness, balance, and presence where every moment is both unknown and perfectly enough.